All right. Well, I think we're going to get started on the offshore financing panel. I think preceding us, we had some really good conversations from the ship owners and the operators around offshore oil and gas and offshore wind. And today we're sitting down with a number of esteemed financing providers to discuss, capital that's available to these companies. From my own perspective, having worked 20 plus years in kind of marine and offshore, I look at the wind and the offshore oil and gas market being pretty different markets. And I think we've got individuals here that can talk about both markets, and we've got individuals here that are just going to be focused on one of the markets. But it's going to be interesting to see how the two markets have diverged and how they may come back together in the future. But for folks that don't know me, my name's Chris Weyers. I've been doing marine and offshore investment banking for the last 20 plus years. I'm one of the senior partners at AMA Capital Partners. I think a lot of people know the firm, but we're one of the largest dedicated boutiques that literally only do marine and offshore. And we've been spending a lot of time on private capital raising, which is really what we're going to be talking about during this panel. So I'm going to real quickly for an agenda introduce the panel participants at a high level. Then I'm going to open the floor to each panel participant to kind of talk about themselves and their business. And then I've got a bunch of discussion topics that we'll go through. But the panelists immediately to my left the first one is Evan Uhlick. He's the head of Ocean Industries North America at DNB. Then we've got Alfredo, we got Harris Antoniou next to me, who's a managing director at Neptune Maritime Leasing. I believe he's also the founder of Neptune Maritime Leasing. Next to him, we got Hunter Bollman, who's a leveraged finance investment banker at JP Morgan. He's worked on a lot of the big offshore drilling financings that happened late last year and earlier this year. And then we have Alfredo Marti, who's one of the co-founding partners of Sandbrook Capital. It's one of the dedicated private equity funds that just focuses on offshore renewable and onshore renewables. So with that, Evan, do you want to start? Just introduce yourself.
Sure. I thought you introduced me, Chris, but congratulations on your big move, by the way. And a little shout out to Fortis Bank here. We got a couple of alumni on the panel, so I like that. A number of distinguished Fortis alumni in the crowd, so it's good to have everyone back. As you mentioned, Evan Uhlick, Ocean Industries here in North America. I think we're the only financial institution to have an exclusive ocean-focused coverage practice, and that includes everything from oil and gas to offshore wind to maritime infrastructure, ports and terminals, and our good friends on the services side as well. So it's a very wide coverage universe up and down the corporate investment banking spectrum, focused on the ocean.
Harris?
Thank you, Chris. Good afternoon, everyone. My name is Harris Antoniou. I'm the founder of Neptune Maritime Leasing. And as the title goes, we are actually involved in leasing for ships. Initially, the three main sectors, but we recently took the decision to add offshore, both offshore oil and gas and wind, to our sectors that we cover. So we're very excited by the prospects that the offshore industry is offering now. And it actually reminds me of sort of the beginning of my career in the early 90s, where in fact we saw very similar trends, and I'm talking about the offshore oil and gas industry now. As the industry was coming out of the recession of the late 80s, companies were restructured and demand was increasing, and I see exactly the same trend now, with the caveat that now not only do we have oil and gas growing in terms of demand, but we also have the wind industry taking off. So that creates very, very strong tailwinds for the sector. So,
Hunter.
Cool. And Hunter Bollman, I'm an executive director at JP Morgan, been with the firm for about 12 years. I help lead our energy leverage finance origination group, primarily covering oil and gas as well as power and energy renewables. And in particular, as Chris highlighted, I've spent a good portion of the past year focused on the offshore drilling transactions.
Alfredo Marti with Sandbrook Capital. We are investors in the renewable energy sector, private equity investors, and have been doing that for about 15 years. Previously at a firm called Riverstone, where we were very active in the renewable space, including offshore. We used to own CJAX for a few years before it was sold to Marubeni and then Eneti. And then a couple of years ago, my partners and I stepped out to create a new firm, Sandbrook, where we invited a bunch of other investors from Blackstone, KKR, Apollo, GIP, et cetera, to bring more capital, more private capital, into supporting the growth of companies like the ones we're talking about today. Very active, not just in the generation of power, but also in all sides of the supply chain, including offshore wind, where one of our first investments was backing a Norwegian company called Hafram. We have the CEO and CFO here as well. And so that company is in the same business as Eneti and Cadeler, who presented just a moment ago. So happy to talk about any of that.
All right, thank you. So I want to start my questioning around kind of the offshore oil and gas space, and then we'll kind of transition into offshore wind. One of the things we've seen in offshore oil and gas is, a real difficulty for quality companies to get competitive financing terms, particularly in the debt markets, but we see it to some degree in the equity markets. The industry obviously had one of the largest downturns, I think, we've seen in just about any industry, and creditors lost enormous amounts of money, equity holders lost enormous amounts of money, but now the industry, seems to, be largely recovered. Companies are earning, record profits. Leverage levels are very low because most debt got equitized during the previous downturn. But when we talk to, owners, it's very difficult finding capital, and we've seen some companies have issues with capital raising, public deals that get announced and then get withdrawn. So I know we've got three kind of experts up here around offshore oil and gas. Maybe start with you, Hunter, because I know you've completed a few recent big financings. Be great to get your thoughts on kind of cost of capital and availability, and what gives these companies that are able to do these bond deals the ability to do them? Because there are lots of companies out there that want to do them that haven't been as successful.
Yeah, thanks for the question. If we think about the offshore drilling space in particular, a good majority of the companies went bankrupt over the past couple years, and investors lost a lot of money in that. And those are debt investors on the institutional side, as well as banks. And so if I think about what's happened this year, right, debt investors have both long and short memories. The institutional debt investors that buy high yield bonds have much shorter memories, right? It's very much about what's the return on my capital today. What is the industry outlook? And I think from all the speakers earlier today, the industry outlook in offshore oil and gas is exceptionally strong and the best that it's been in many years. So what have we seen in the offshore high yield space? 4 deals have gone to market for 3 companies raising about $3 billion this year. Noble went to the high yield market to raise unsecured bonds. Weyers raised second lien bonds. And then Transocean has done some asset level financing, as well as some corporate level financing. And those have gotten done at very attractive terms. With Noble and Weyers getting done at 8 3/8, and those bonds are trading about 7.5% today. With respect to the bank side of that, with banks, right, much longer term memories, just because of the sheer amount of capital that the banks lost. And so what we've seen is highly structured deals are getting done today, but lenders on the bank side are being incredibly judicious about wanting to make sure they are top of the capital structure with no additional debt beside them. They want to see very attractive leverage terms and asset coverage. And then on the high yield side, we've seen investors be very discriminatory on covenants, right? If you think about why did all of these investors lose money in the downturn, a lot of them lost it due to bad structure, right? Those were investment grade companies, the drillers that got downgraded, right? So they had IG covenant packages that basically didn't limit restricted payments or debt incurrence. So what we've seen primarily from my experience is the deals are getting done, but investors are incredibly focused on low leverage, kind of 1x is kind of the key theme that we're seeing with both Noble and Weyers getting done. Very tight covenant packages. You know, it was interesting listening to Chris and Richard talk earlier today about restricted payments, right? And a lot of return of capital to shareholders. I think debt investors fully expect that in the offshore space. They've been supportive of that, but they've been supportive of it at manageable leverage levels. So call it 1 to 1.5 times is what debt investors are comfortable with cash leaving the system. But I think gone are the days of unlimited leverage and massive distributions without being at a manageable leverage level.
Thank you, Hunter. Evan, it would be great to kind of get your view as kind of a relationship bank lender on these markets, and you know what can and can't be done as it relates to bank loans, and what you're seeing in terms of kind of competition. I know if we went back, you know, 5-6 years ago, there were a lot more banks in this market, I think, than there are today. So I'd love your view there as well, and what it's going to take to get more banks involved.
Thanks, Chris. I thought Hunter answered incredibly well on what's happened in the last 6 months. If I could kind of raise the lens a little bit, I remember being at a TK cocktail party in Christmas of 2019, and the ESG fervor. It was like all people could talk about was just ESG. And that was right before COVID hit, and all of these companies came into COVID with you know, these massive headwinds of both ESG, emissions, and then incredible amounts of leverage against a very weak to de minimis backlog and revenue stream. And it was at that point that you know, they had to go through, virtually the whole industry was baptized anew in the soothing waters of Chapter 11, and have come out of it. And these companies that were able to access capital either did a phenomenal job at liability management throughout the downturn, aka Transocean, and Transocean was quite fortunate in having and buying a really solid EBITDA backlog. Transocean really opened the industry in January of 2023. And then I think what you saw is investors taking a very sober look at the credit metrics of Weyers and Noble, and just getting inherently comfortable with the overall kind of cleansing that happened, the de-risking that happened, and the prospects overall. You know, as many of you know, these capital market offerings are usually married with some type of revolving credit facility to accompany them. And in the case of Transoceans, that was completed in late 2022, and Weyers and Noble, the revolvers were completed side by side. Again, as Hunter mentioned, the structural seniority element was just kind of an absolute red line, and I'm not talking about an Obama red line. It was, you know, it was a real clear red line where we had to be structurally senior to the bondholders. That was conclusive. The U.S. investment banks that often operate with a different set of calculators around revolving credit facilities, they sniffed the capital market fees and were able to cut pretty good deals around economics. What you saw were absent, as you well noted, was the traditional kind of international banks that have been, by and large, very supportive of the industry. Rightly or wrongly, DNB was robustly invested going into this part of the cycle. We held on to a number of our challenging situations, patiently worked through it. We actually made a ton of money on some equity positions coming out of it, and we're able to stay invested and stay committed, albeit at a lower total quantum, into this part of the cycle, and feel really, really good about the companies that we supported. What's gonna draw more creditors back to the space? I think time will heal a lot of the wounds. I think continued solid governance, continued solid performance by these institutions, maintaining, whether it's 1 time or 1.5 times, it needs to be a very responsible quantum of leverage. And I think these companies all need to be at the forefront of ESG best practices, so to speak, with an eye around how to be present and engaged within the energy transition. I think if they do that, they will attract more creditors over time.
And how much of the difficulty of offshore oil and gas getting credit do you believe is the function of its history, recent history, versus kind of new kind of ESG movements? Because we hear a lot of creditors struggling to finance offshore oil and gas, or really anything oil and gas related due to ESG. And anyway, this industry has 2 challenges, I think: history and ESG. And I'm just wondering, from your guys' perspective, what is the more important one?
I think from the broader macro perspective, we take a step back from offshore, right? I think Evan's comments were spot on. We've seen a lot of banks run for the hills, particularly quite a few European banks that are flat out moratoriums. We are not going to support the oil and gas industry, period, full stop. And so I would say an example would be like an exploration and production company, right? I'd say about 5 years ago, there was probably 40 normal lenders that were playing in credit facilities. Those are probably down to 15 to 20 today. With respect to offshore in particular, right, I think it's a little bit less of the ESG pressures, right? I think the deals that are getting done in the large public companies are doing a really good job selling that ESG story. I think the problem with the bank market is just the sheer amount of losses, and that banks have those longer term memories. And so when you go talk to your credit officer and you're like, hey, I want to commit $50 million or a couple $100 million, right? That's not going to make someone's career, right? But what is going to break someone's career are the losses that they're going to take. And so I agree. I think it's going to take sustained involvement, right, and a sustained structure in quite a while to get a bunch of the banks back into the capital, back to lending capital. But I will say I think banks are also eyes wide open that we just faced an industry downturn. Knock on wood, we're in the midst of hopefully an offshore super cycle, but we are going to have a downturn again in the cycle. And I think banks are wanting to make sure they get the structural protections to ensure that when that downturn occurs in the future, and hopefully doesn't occur for many, many years from now, they are fully protected.
Harris, so you're kind of the dedicated private lender, sitting here, that has done, both offshore wind and offshore oil and gas. And we see kind of a lot of the challenges with the banks and, and the traditional kind of PE and private credit funds, with ESG. How are you looking at it? Like, you seem to be in a pretty unique spot.
Well, we looked at sort of creating value last October, actually October 2022, when we started looking at the industry. And it was pretty clear that the exploration spending was going up. It was 22% up last year, 30% up this year, which means that the oil companies, driven by the increased demand for oil, and remember we're up at $100 million barrels a day, figured out that they have to spend more money on getting oil out of the ground, which they had stopped doing for years. So suddenly you see this increased demand, which needed to be met by supply. And obviously you need equipment for this. And we're talking about energy transition. You correctly said that we need to focus on renewables, but that's not going to happen overnight because there are challenges in renewables as well. But at the same time, we need to meet our energy demands. So actually, us being involved in the sector is a result of 2 things. One is that we needed to make sure that we help the world with its energy needs. And in fact, in Europe, it's even more acute because it's not just a need, it's energy security. The second issue is that as demand moved up, and we looked at who's going to provide the required capital to fund the vessels, acquisitions, new buildings, etc., we saw a dearth of supply because the traditional banks, at least in Europe, maybe the US is a bit of a different story because we're talking about larger companies involved in the sector, but in Europe, there's absolutely very little interest from the banking sector to fund the oil and gas business. We're focusing mostly on OSVs, which is, supply ships, anchor handlers, and deep sea construction vessels, not on drilling so much. But even on those sectors, there's very little activity going on. Most of the banks are trying to maintain the position to gradually exit. And some other banks that are larger and have a more entrenched position, they're trying to pick sectors that are more ESG friendly, if you will. So that's the environment. That's what's happening. So we thought it was a very interesting opportunity. Of course, you can appreciate that, as a result of the demand, rates have gone up, values have gone up. But mind you, they're nowhere close to, or they're getting there. They're nowhere close to the peak of the 2008. But there's one fundamental difference, and that is that in 2008, 50% of the fleet was on order, and now we have practically 0% on order. So I think the fundamentals are pretty good. That's what made us decide to move into the sector and start helping companies, no matter how large they are, fund their growth needs. And that's what we're here to do.
All right, thank you, Harris. I think we'll transition to offshore wind, and then we'll come back and conclude around these two sectors. But Alfredo, it would be great to get your thoughts on kind of the dynamics around investing in offshore wind and how it's different and changing relative to oil and gas.
Yeah, it's pretty different in many ways. Obviously, you don't have the cyclicality that you have being driven by the oil and gas price, but also from the capital markets, there is as everybody here probably appreciates, and in the previous panel, Mikhail made a strong point of there is abundant capital, both debt and equity, looking to participate in the much needed growth in the offshore wind space. Now, I would say that the offshore wind sector tends to be more specialized than other parts of the renewable sector. Certainly in the US, you've seen that areas like generation of power from onshore wind and from solar have had tremendous growth and maybe too much capital flowing into the sector in the last couple of years. In the offshore wind space, it tends to be, the risks are higher, the amounts of capital involved, certainly in the WTIV space, is much higher, but the capital is there for the companies who have the track record and the ability to secure contracts and so on. And that we're seeing that, I guess we represent that from the equity side, where we are the beneficiaries of having a number of institutional investors look to us to help them deploy capital in the sector. But then also when we partner with people like the ones in the panel on the credit side, we're finding that you can actually get the assets built because the fundamental economics are more and more sound.
So Alfredo, the thing that we hear in offshore wind and we see a lot, particularly around the U.S. offshore wind, but I think it's true to some degree in Europe as well, is there's a lot of kind of things that are being developed and vessels that need to get built and investment dollars that need to be made, but there's not a lot of long-term contracts. It's mostly short-term spot. It feels pretty risky potentially. Like how do you look at when do these projects become investable? Do they need a long-term contract? If they don't have a long-term contract, how do you get comfortable with the return profile?
Yeah, so I'll say there's certainly a lot that doesn't get built for lack of long-term contracts, but the contracts are sufficient to underpin a lot of the growth that is happening. So you see the amount of wind getting built in Europe, all of that is, or the majority of that, is underpinned by some sort of PPA or contract for differences, et cetera. So the developers, so the companies like Equinor and RWE and BP and Vattenfall, et cetera, they all have the ability to sign those contracts that are underpinning the investment. And then when they turn around to the supply chain, it is definitely not a 15-year contract if you're looking to put to work an installation vessel, but as previous panel was commenting, we're going from 1-2 year contracts to 4, 5, 6 year contracts. Historically, just for the nature of the operation that we're talking about, when you go and hire a vessel to install to build a wind farm, you typically historically have hired it to install one wind farm, and that's typically something that takes about a year, maybe 2 if it's a large wind farm, to do. So contracts used to be 1 or 2 years. I think what's happening now is two things. One is that these projects are getting much larger, so your typical large-scale wind farm is now more 2 or 3 years to build. And then the second thing is that companies are getting more worried about securing both the access to the equipment as well as looking in pricing, given the inflation turbulence that we've seen in the last couple of years. So the contract tenors are getting extended. Not to 10 years, but yeah, we are seeing contracts 4, 5, 6 years, which are at the right pricing, sufficient to underwrite kind of high quality equipment.
And Evan, your group at DNB, I think, finances both offshore wind and offshore oil and gas. It'd be great to get your thoughts on, when you go through credit committee, when you talk to your clients, how do you guys evaluate those two sectors? What's different? What's similar? Is there a cost of capital differential, between the two at the bank lending level?
Just before I get into that, there was some comments made on the previous panel, plentiful availability of capital, and we could all be hopeful, but let's just be clear that there's to date there have not been a tremendous amount of deals completed within the space. Banks have been given, certainly European banks have been given very clear guidance that the future is green. The energy transition or the green shift is real, and we should be looking for good opportunities with high quality assets with the potential to work with export credit agencies to put capital to work around these very sexy sectors right now. So I think for the few high quality projects that are done, there have been willing participants. I would also just say, and again, not to let's keep the party going, but these are pretty structured deals. I mean, these are pretty tailored deals, and there's generally kind of steel tranches, and then there's expandable, quantums of capital available that are based on contracted cash flow. It's the Jerry Maguire, show me the money, kind of thing. Having contracts is real proof of concept in these situations here. So I just wanted to point that out. It's one of the most interesting dynamics going on here, certainly within the services space, is the quote-unquote hydrocarbon versus renewable dynamic, whether or not you're a pure play hydrocarbon services provider, and in that respect, are you best in class of all of the litany of ESG best practices? Do you have your emissions in order? Have you come out with a ESG annual report this year? These are all extremely important things that may not be quantitatively monitored, but are absolutely qualitatively monitored. And for the most part, the next question is, well, what are they doing on the renewable side, or what's their diversification strategy? And even if it's 2% of revenue, or some de minimis amount of EBITDA, we need to be able to show that there are aspirations and ambitions and a strategy that's not purely hydrocarbon. That there are either, again, this green strategy or diversification, or they've invested in hydrogen, or they've linked up with a JV partner that does CCS. This is all part of the dialogue right now, and the absence of those ambitions probably raises more eyebrows than not.
And is it getting harder, Evan? Like I know a few years ago a lot of companies did, like, I don't know if you call them green loans, but loans where if they were able to hit certain emission targets, they'd get a 25 basis point savings, but they were relatively easy to hit. Like, are these new targets? Are they harder? Are there more measurements? Is there more risk associated with them? Just curious your thoughts.
Yeah. Well, I'm actually extremely pleased if we, again, go back to this fourth quarter of 2019 when there was, really almost evangelical ESG discussions to today, which I think is a much more mature and nuanced conversation about the role of hydrocarbons, about the role of the energy transition. I think there's been, an increased awareness, perhaps through the horrors of war, that energy security is important, that this is not a short-term, flip a switch type transition, and that we're all going to have to play nice in the sandbox for a little while, brown and green. And I'm very pleased that kind of level of maturity of conversation has occurred. The other component of this is, I would refer to some of what you were talking about. This is a bit of window dressing. To get 25 basis points because you've hit some target that's already kind of been pre-identified and almost pre-wired. Is that really going to move the needle on companies' decision to allocate capital? I think that the penalties need to be higher and the incentivization needs to be greater to truly change behaviors. And inherently, companies want to change these behaviors. I don't believe that any responsible company out there is jumping up and down and saying we don't want to be responsible or we don't want to lower our emissions. And so it's being able to marry, I think, the inherent desire to do good for the planet with the financial incentivization to get there faster.
And Harris, I know you've done, I think, at least one offshore wind financing. It'd be good to get your views, on kind of what you're seeing, what you think could get done, how ESG is, helping or hurting you, like doing new deals.
It's not a luxury item anymore. I think we're hardly doing enough as a sector to, in fact, fund or expand the horizons of what is possible in relation to offshore wind. Because if you look at the requirement, we're talking about, gigawatts of power. The reality today is that in Italy, they're rationing water. We have wildfires everywhere. And so there's no doubt in our minds that we have to do something, right? But are we doing enough? I don't think we're doing enough. I think we need to do more. And I don't think the risk appetite is there yet to fund the transition. And why do I say this? Because I look at the statistics, and the statistics in Europe say that we need to build another 30 gigawatt of wind by 2030 to reach 200 gigawatt by 2050. That's a massive, it's like 400 terawatt of power. This is the production of France or the consumption on an annual basis. So it's a lot of power that needs to be generated. And to get to that target, we have a requirement for more ships, not only for installation, but also the OSVs, CSOVs, SOVs, etc. The statistics tell us that there's anywhere between 100 to 200 ships of shortfall right now to reach our targets. So who's going to build those ships? And if you look at the availability of funding for them, it's not really there because the contracts are not long enough. So the investors or the banks are not prepared to take the risk that's required to actually fund those vessels. And mind you, these are not cheap assets. We're talking about 60 million, 65 million euro on a pop. That's a lot of money to put to work. So we need to walk the talk if we want to get to our ambitions. We're ready. We're there to support the industry. And we look forward to doing so. And actually, when I say support the industry, I'm talking about, investment across the capital structure because we can, we're a lessor, of course, so we do ship leasing. But if there's a requirement to look at other elements in the capital structure, we've actually made the decision to be able to do that as well.
Okay, thank you. So I think it would be kind of interesting maybe to get, views from the panelists on a recent investment or financing that they've done in the space. I know Alfredo, your fund, made a recent, one. Maybe you could give us some color on it and kind of why you did it, and love to go down the line and see if anybody's got a good relevant example.
Yeah, I mentioned in the introduction, a few years ago we did a transaction where we took or we helped Seajacks go private and then build their fleet, and when it was all contracted and operating really well, that company was acquired by Marubeni, and it's now what used to be Seajacks, now becoming part of Caterpillar. We last year or a few months ago, we went back into the sector in what we think is a pretty interesting transaction. We helped the management team of Hafram, which was doing both oil and gas subsea installation and offshore wind, and we're finding that it's actually, in the current funding environment, it makes more sense to do that as two separate companies. So we basically acquired the offshore wind side of that business, and we brought our fund capital as well as some pension fund capital from Canada and other parts of the world, and we backed new Hafram, the offshore wind division of Hafram, with $500 million of equity to go build a fleet of, for now, primarily WTIVs, with a combination of this equity and financing from banks like DNB and others. So those ships are currently in construction. In the last 4 months, I think the company has announced 3 anchor contracts with 3 of the top 5 owners of offshore wind in Europe. So it's definitely, as my colleagues have said, it's far from easy to get all of this done, but this is an example of how you can, with the right assets and the right management team, with a ton of track record, et cetera, you can bring all of the right parties to the table and get some of this infrastructure built.
Very good. Hunter, do you have a transaction?
I was just going to highlight, I talked a little bit about the Noble transaction. What I thought was most interesting, and I carry this over to Valeris, and then I've been working with some members of Evan's team on a bunch of other items in the OSV space and drillers as well, is the challengingness of getting bank capital today, particularly in an industry. So we've talked a lot about the high yield market being receptive to high quality credits, but banks are still being super conservative. And I highlight that because, when you think about like the Noble credit facility, that's probably got 7 or 8 lenders. Valeris probably has 5 or 6. Transocean probably has 3 or 4. Is the importance for companies that are looking to get bank capital to start spending significant time with banking relationships early in the process? Gone are the days of which, a bank launches a syndication and, it's oversubscribed, or banks are flocking to put more capital to work in the space. It's really on companies and management teams to largely syndicate their own deals. And so I just highlight that as something that we've seen in the offshore space is just, while there has been limited bank capital, it's really important for management teams to start spending those relationships months in advance of a potential transaction, right? So that it's on the doorstep, it's having those good relationships.
Yeah, that's very interesting and definitely good advice. Harris?
Look, as I said, last year there have been 6 deals done on the PSV space from KSs in Norway. So because there's no debt, everything is funded 100% by equity. And there was another 4 deals done this year. So, what we're saying is, by deploying capital through leasing, you're able to release equity to, reinvest or in fact improve the returns for your shareholders, and that's what we're here to do.
Evan?
I guess I would just highlight this wonderful energy transition that we're all faced with. Over the last couple of weeks, DNB was the financial advisor for Caterpillar on the merger of those 2 wonderful companies, creating a real industry leader, which we're very excited about. We just completed a $100 million bilateral SOV financing for a Louisiana-based private ship owner, and at the same time, we're out in the market today with a Nordic bond for Tidewater. And if you kind of mix that all together, to me, that is the beauty of the energy transition, that all of these things can coexist together, and we can hopefully do it well.
Very interesting. Well, I see we're about out of time. I can't really see Mike or Matt, but do we have time for Q&A, or should we wrap up? Okay, so we'll take one question.
Gentlemen, thank you very much. Emily Felt from the U.S. Department of Energy. We do financing now, Loan Programs Office. To what degree are you looking for the vessels to be differentiated by their fuels, their propulsion systems? To borrow what you said, Harris, to what degree are the vessels going to be walking the talk on ESG in terms of fuels and lower greenhouse gas emissions? And how do you think about that financially?
Look, at the moment, it's a large topic, but what's happening definitely in Europe right now is operators are looking to enhance the environmental footprint of the vessels, and there's significant efforts to replace auxiliary engines with battery packs, which means that when the vessel is stationary, it doesn't have to operate that auxiliary engine 100% of the time, for example. So that creates savings in terms of CO2 emissions, and that's definitely something that some of our clients are looking to do, install this type of packs, battery packs on the vessels, and we're happy to finance those. When it comes to the energy transition, though, for shipping as a whole, there is a discussion about new engines, new propulsion, etc., and new fuels. So there's talk about LNG, there's talk about methanol, there's talk about ammonia. LNG is proven. Methanol is also proven as a technology because it's already been installed in tens or dozens of ships, ocean-going ships. We haven't seen this happening yet, if I'm not mistaken, on the offshore space, but it is happening on seagoing vessels. So it's only a matter of time that technology improves. And personally, I'm invested in the fuel cell business through a company which is listed here. It's called Advent Technologies. And we're doing a lot of efforts into, in fact, installing those fuel cell systems onto vessels, auxiliary engines to start with, but through time it will come to the propulsion of those ships as well, which goes back to the hydrogen economy, as a matter of fact.
Anybody else want to say anything there?
Well, maybe just a quick comment to say that we care hugely about that, and we're not only because it's the right thing to do, but also because if you're going to build a multi-$100 million vessel, you want to future-proof it. And now there's elements of that are already mainstream. So, for example, the vessels that Havfram is building now has the benefit of the advancements in technology and the cost curve around batteries and the generation of power when you're moving weights and cranes and jacking up and down, etc. So all of that is built into these vessels, which was not the case just in the most recent previous generation. There are, as Harris was saying, there are other parts of the equation that are a little bit more ambiguous still, like the mix of fuels for the combustion engines, and that side, the interest is still to future-proof and make sure that we're building vessels that are going to be desirable and responsible, not now, but 10 years from now. But the emphasis right now, in some cases, is more on flexibility to make sure that you can adapt to what ends up being the prevailing fuel and the most economical solution, rather than necessarily locking yourself in today on those aspects.
All right, well, I think we're done, but thank you, panel, for a very interesting conversation.